the dividend that they're taking is after tax. It's not before tax, it's after tax. And so many people do not budget for that corporation tax bill.
If you only speak to your accountant once a year, you're running your business blind, and that can be a very dangerous place to be. Most business owners, they don't fail because they're bad at what they do. They fail because they don't get the right guidance when it matters most. Now, in today's interview, I'm going to be speaking to Jeff Wingham of CIK Accounting Solutions, and that stands for Cash is King. I'm really looking forward to this interview, and we're going to be talking about why traditional accounting methods perhaps are failing you in your business and what you should be doing instead. If you keep relying on outdated advice, expect cash flow nightmares, expect missed opportunities and financial disasters that most directors could see coming. You need real support before it's too late. Jeff, welcome to the Director First podcast. Thank you for joining us today.
Thank you, Chris, and thank you for inviting me.
You're welcome. Jeff, I want to sort of start with, obviously, I've been snooping on you on LinkedIn for probably the last month or so. And I invite people on as a guest when I have a look at what they're putting out there. And I think, you know what, my viewers would really find that interesting. And I want to dive into really one of the things that you posed a while ago, which is, what does a business owner need from an accountant?
Yeah, okay. I think so much more than just a tax return, which is the traditional view of what an accountant does. And obviously that is still a part of it, but there is so much more that an accountant can provide and perhaps should provide, especially in today's world. I think the first thing is, if a new client approaches us to come on board, we have a discovery call, and we're really trying to deep dive into what it is they're doing and to understand their trade sector, because not all trade sectors would be a good fit for us. And I think, again, it's a thing for me that an accountant trying to be all things to all people probably isn't going to work. You have your niche and you should stick to it. So understanding the trade sector the client is in, and really I'm trying to understand, to take the time to understand the client, where they're coming from, what makes them get up every morning, and even what does their exit plan look like? And I know that's maybe a strange question to ask right at the beginning, but so many business owners start a business and have no idea what the plan is at the end of the day. But that's crucial because, a business, fair enough, it's your baby, but at some point in time along the journey, you're going to want to cash in the chips and sell that business. And it's important that you set up from the beginning, lay your stall out, as it were, in terms of how you're going to create a sellable asset. From there on in, I think an accountant can then help the client come up with a plan and how their goals are going to be achieved, and break that down into manageable chunks, and then have constant dialogue with the client as the journey progresses. So definitely not a once a year exercise. We have some clients I speak to on a weekly basis, others monthly, others quarterly. But I think if you're only speaking to your accountant once every 6 months, once a year, that's dangerous. You're missing out on potential tax saving opportunities, and just general help with how to run the business beyond just the numbers. And of course, as time progresses, you as a business owner undoubtedly will have to adapt as things change. So whether that's changes within your business or whether it's changes in a wider business economy, sector. So for example, you've already mentioned there, Chris, about the changes that are coming in with the budget, and I'm concerned for many clients or many businesses as to the impact of some of these changes that are about to happen in April. And so basically an accountant that has the experience and the empathy to take you on the journey, because it's not just a set of accounts and a tax return at the end of the year. And if it is, you're missing out on so much more.
I mean, so much I wanted to sort of jump into in that short space of time, but I think I'll start with the first thing that, obviously, in my industry, I get the director will call me when they've not followed advice, they've not set a plan, they just, and I think lots of us, and me included, I remember when I set up this business, I had no plan. I just thought, you know what, there's a gap in the market here. I will give it a go. And it was no more than that. I would go out there, I would get some work, I would, work with our insolvency practitioners, they'd pay me, I literally had no idea what I was doing from month to month. I just thought, right, well, I know it's going to cost me that much to sort of run my business in marketing, in staff. I'm going to need to take some wages. As long as I'm there or thereabouts, I'm going to be okay. And then every now and again, you got a VAT bill and you're like, flipping it, where's that come from? And then, and I've got to be honest with people, it took me a lot of pain to actually tidy myself up. I wish I did as I told with people, but sometimes I will, it takes me a while to catch up. But one of the things I want to talk to you first about is a director will ring me. They will have issues with, HMRC, funding, costs are going up, sales are going down, they're staring insolvency in the face. And I'll be, the first job we've got to do is go, right, well, is there anything else we can do? It's really easy to just put a company into insolvency, but can we rescue this business? Is there some restructuring that can be done to save it, give it some breathing space to get back on its feet? And the first thing I will ask is, have you got some management information for me to take a look at? Because the last thing that I can see that's publicly available is some accounts that were done 2 years ago. And then they'll go, oh, well, my accountant never does that for me. And I'll go, well, do you pay them to do that for you? I don't think directors understand the difference between the basic stuff that you guys have to do for them, just the statutory requirements, and everything else that a business really needs to make better decisions. So could you sort of just go into that for our viewers, Jeff? Like, what's the stuff that an accountant has to do every year that you're not really going to get much benefit for? And what are the things that they should be doing on a monthly or quarterly basis?
Yeah, sure. So the stuff that has to be done is the annual statutory accounts, which then have to be submitted to both Companies House and HMRC. That is a historical look back on the business, which could be anything up to 18 months old. The value to you, absolute zero. Zilch. Means nothing other than ticking a compliance box. Obviously, your tax return then has to be completed as well and submitted to HMRC, and the tax bill, the corporation tax bill, has to be paid 9 months and 1 day after the end of the accounting period. Which again, dare I say, traditionally there are a number of business owners who leave everything to the last minute, and the worst case scenario is that the accountant is telling them, by the way, Jim, on Monday next week you've got a tax bill of 15 grand, and Jim goes, oh well, where am I going to get that from, because I didn't realize that was coming. So all sorts of problems there. So compliance work, which you really described there, brings, in my opinion, no value to the business owner at all, other than keeping them out of jail.
Mhm.
What you should be doing, as an example, would be, you've alluded to CIK, stands for Cash is King. So very big for me is you should have, at a minimum, a 13-week rolling cash forecast, where you are predicting what your income and expenses are on a week-by-week basis for the next 13 weeks. And then you populate that at the end of each week once the actual results are known. So at the end of week one, you put in the actual figures. You might then review the remaining weeks based on what's actually happened. And obviously remember to add on effectively week 14, because week one has dropped out of the equation. So you've always got this rolling 13-week period. And at the start, you might not be very accurate. That doesn't matter. It's doing it that's important, and tracking it on a week-by-week basis. And I promise you, if you do that or your accountant does that, you will get so much better at it. And there will not be the same amount of shocks to the system if you adopt that approach. And that will highlight, by the way, your due VAT bill in 3 weeks' time. Have you ring-fenced that money away? Is it already there, or have I got a bit of a problem between now and then? Do I need to get short-term overdraft? Do I need to look at other short-term finance options, whether that's invoice factoring or whatever? Which isn't my first choice, by the way, but the important bit is it's flagging a potential problem. Mm-hmm. Equally, it can flag times of the year when cash might be good, really good, and you can maybe look to put that away, and if nothing else, get a bit of interest on it until you need to draw on it again. So that's one thing.
Before we go on to the next one, though, Jeff, can I just dive back into that? Because
sure.
A rolling cash flow forecast, very, very important for everyone, 100% with you. But for people out there that don't know how to do that, because I'll say to somebody, listen, we need to start doing a cash flow to see what's going to happen over the next 3 months. And they'll be like, oh my, they're just so overwhelmed with what I've just said. Like, you don't have, it would be great for an accountant to do it, okay? But to do a really primitive one to start with, anybody can do this with a spreadsheet, can't they?
Absolutely. We have a template that's free to any client or anybody listening to this, Chris, if they want to get in contact. Happy to give them that template. Happy to give them some guidance notes on how to populate it. And yeah, you're right. It doesn't need to be any more complicated than an Excel spreadsheet. Although there are bits of software out there that will do fancier cash forecasts, but you don't need that, especially if you're starting off. You don't need to spend lots of money on it.
And it's just money that you expect to come in.
Yep.
If I say to people, right, listen, find out what your balances of all your accounts are, get on there, put that in the spreadsheet, how much you owe on loans, how much you owe on credit cards, and anything that's coming in, as simple as that is, it's just a number that you expect to come in, and anything that you expect to go out, you just put a minus in front of it. And again, I go really caveman style on these things, so somebody who's watching that can actually perhaps come off this and go, you know what, I'm going to have a go at this right now. And hopefully you're going to get in touch with Jeff as well for the template. But it's just pluses and minuses, and at the bottom we'll have a figure, won't it?
Absolutely. Caveman's good, Chris, or cavewoman.
Yeah, okay. But no, thank you for that. It just helps people understand, giving them actionable steps that they can watch, or if they're listening to this, they can go and do something. But sorry, yeah, please move on to point two.
Yeah, point two really was rather than getting just a set of annual accounts, which, as I've said, is very historical, not really any use to you at all. You should be looking at monthly, ideally monthly management accounts, or quarterly. And a lot of people say, well, we use software. All I have to do is press the profit and loss account, and that's it. I don't need you as an accountant, Jeff, to tell me what my profit and loss is on any day of the week. And my reaction to that is really, it's not as simple as that. You're buying into advertising carried out by software companies that would suggest that it's as simple as pressing a button, and it's not. And there are so many reasons why pressing the profit and loss account without doing any checks on the data is such a dangerous process. So, for example, have all the bank transactions been pushed through? So in other words, if in an accounting software program, your bank feed is going to be connected to your software, and you then have to push those transactions through. By that I mean code them to, was it stock materials? Was it advertising? Was it rent payment, etc., etc.? So have they all been posted? If they haven't, then hitting the profit and loss account button is not going to tell you what your profit and loss account is, because you've just left out a whole batch of transactions that aren't in the system. But even if they have been posted, has anyone checked that the balance that your software is seeing that's in the bank account agrees to the physical bank statement? Now, I know technology is a wonderful thing, and it really is, but from time to time, you do get hiccups. So it is possible to get duplicate entries, for example, within your software, or lines missed out completely. So you need to check that the balance agrees in the software to your bank statement. The other crucial one is if you carry stock for resale. So if let's say you're a plumber and you have various materials in the van and maybe in the shed at home, is the value that you have in the accounts for those items, is it accurate? Because if it isn't, then again, your profit and loss account is going to be severely restricted in terms of its value if the closing stock value is not correct, if it doesn't reflect reality. And there are so many potential problems with that. You can easily overstate profit by saying that your stock value is higher than it actually is, and equally the other way around. So if the stock value in the accounts is less than what it is, then you'll be showing a lower profit than what actually maybe you've achieved. So it can work both ways. It's not all negative. It can be both ways. The other reasons would be, are your debtors and creditors correct? So by that I mean, are the balances in your software that you're due from your customers, are they right? Have you gone through that? Have you checked that the amounts that the software says is due are due? Are there debts in there that are 2 years old and should have been written off because you've got no chance of getting that money? On the creditor side, so in other words, money that you're due to pay out to your suppliers, have those balances been checked with the supplier statements? If not, then how do you know that that's right? So these are all these sort of things can contribute to why a profit and loss account wouldn't be accurate. And possibly lastly, you should be also reconciling things like your VAT account. So the VAT per your software, does it agree with what you think it should agree with your VAT return? Does the PAYE agree with what HMRC thinks you're due to pay? So for a whole host of reasons, and unless you're going to carry out these checks and more, hitting a profit and loss account in your software in isolation without doing any of these checks is highly dangerous. Sorry, I've gone on a bit there, Chris.
No, I mean, listen, I was laughing at the start, and you know, I want to be transparent with people who are watching us. I remember when I first started this business, and obviously, you know, I was very much by the seams of my pants. I wanted to cut costs everywhere, and the girl who worked for me, I said, listen, can you, I sort of forced her into saying, yes, I can do this. Okay. Because I didn't want to pay I think it was 350 quid a month that I'd been quoted from the accountants to do it. So I thought, right, I'll save 350 quid. And then after about 9 months, I kept it, I was just at the end of the month, I'm clicking the button, this profit and loss. I'm thinking, oh, we're doing great here. And then after 9 months, I just said, listen, this doesn't make sense. What it says on here has absolutely no reality to what's actually really going on. And it transpired that her strong points was not bookkeeping. And she said, Chris, I did try and tell you, but you know, you sort of backed me into a corner with it. And I went to the accountant with my tail between my legs, and it cost a lot more. They had to go back all the way over the 9 months. And again, it's easy to get caught up in that mind space as a business owner. Is like, I'm starting off, well, things are a little bit tight. I really need to save money. I'll try and do it myself. And it's like I could actually plaster my own wall at home. I was a plasterer's labourer once upon a time. I never made it to a plasterer because I was bloody useless at it. But if I try and plaster my own wall, it's going to end up a mess, isn't it? It'll look plastered. And the lesson I learned is, you know, this thing that you're talking about is worth spending money on. It is worth spending money on, even if you have someone in-house doing it, but then you've got someone, a professional, checking it, checking what they're doing before you sort of relinquish control to someone in your business to do the bookkeeping. And that's what we do now. We have an in-house bookkeeper who's a qualified bookkeeper, and I can trust when I hit that button on Xero, which is what we use, I know it's telling me the truth.
Yeah. No, absolutely, Chris. I'm with you 100% there. And I get, you know, especially in a startup situation, a business owner is going to see an accountant as a cost. Yeah. I think you need to try and move away from that idea and see it as an investment.
Yeah,
because we will save you more money than it's going to cost you. 100% if you've got a good one.
Another thing that people sort of, I will see them mess up on regularly, and again, it's something I've done in the past, is having that provision for your VAT, having that provision for your corporation tax, because it's not a surprise, is it? It's coming every 3 months. You're essentially a debt collector for the government, and then you've got to pay it over to them, and your corporation tax is going to be due once a year, as long as you're making that, you know, you're making a profit. So what is the advice that you give to directors about carving off cash to make sure that you're not getting in lumber with the revenue?
Yeah, I mean, I think in general terms, you've got to ring fence that money away. So I would physically, so I say to a business owner, physically open a different bank account. Don't have it all lumped into the one bank account, because you will spend it, because you will think it's yours.
Yeah.
Open another account, call it VAT, call it tax account, call it rainy day fund. I don't care. Just make sure you transfer money in there on a regular basis. Again, especially once the relationship develops with your accountant, the accountant could get really quite accurate in terms of how much you should be putting away every month to ring fence. And I always try and err on the side of caution and put more away than what they actually need. obviously that depends on trading circumstances, but it's really important that you put some money away, because if you don't, then you're going to end up in big problems very soon.
One of the things that we've sort of, and again, it's something that we practice here, is we make it really simple. If there's £1,000 invoice coming in, £1,000, it's a £1,200 invoice with a VAT. You put the £200 in a VAT account, and I know, like, my quarter is due. I think it was paid last week, and it was like, I think it was, the VAT was £38,000 that had to get paid out, and we had about 56 in the VAT account. So you've done it, and you're like, yes, I've met, and a bit of that money can come back into the business to use, and it's the same. What, I don't know if you can put a figure on this, but if you're a business out there and let's say your corporation tax is 20, you're at the rate of 25% now, would you be putting, out of that £1,000 that's left, would you be putting £250 in a tax saving account, or would you be reducing it to 20%, 17%?
That's a good question, Chris. First of all, going back to your first example there, that the invoice for £1,000 plus VAT, and you put the £200 away in a VAT account, that's great, and that's probably traditional advice. And there's nothing wrong with that. If you're able to afford that, great. What I would say is that's probably too much, because what you're forgetting is that you will be able to reclaim some VAT back on some of your expenses. So if you're able to do that, brilliant. If you have done that, to then put another £250 away of the remaining 1,000 in your example, you definitely have more saved up than you require to meet all your tax liabilities in terms of the VAT and corporation tax. And probably you've got a bit of a cushion there in terms of what you need to pay to HMRC for PAYE and national insurance, which is something we've not talked about there. But you would have money in the kitty, as it were, to contribute for that as well. So I don't know if that's, again, if you're having management accounts done on a monthly basis, you should be getting that advice from your accountant. You need to put away X amount. And that would be the most accurate way of trying to put the right amount away every month.
I think it boils down to accurate info, isn't it? And regular conversations with your accountant. Yeah. And as you build that relationship, they'll be able to guide you as well, going, listen, you said it at the very start about understanding somebody's business, and the longer that you're working together, you'll be able to more accurately predict with that management information what's going to be due and when it's due. No,
for sure. And business isn't static, Chris, as we know. So, to say to a client, put away X amount every month, assuming that the trading remains the same every month, isn't realistic. And to then ask them to, well, do this calculation and do that calculation, and you're putting more of the onus back onto the business owner, for me, there's more of a risk that they won't get it right, they won't put away the right amount, which is why you come back to, if you have a good relationship with your accountant and you're speaking to them on a monthly basis and you're getting regular financial information, that conversation becomes an awful lot easier.
I wanted to sort of loop back to something you said in the opening about, you're looking for clients that are right for you. I'm sort of paraphrasing that a little bit. So what do you look for in a client that makes you think, you know what, I think I could have a working relationship with this business?
I think a client that doesn't see the accountant just purely as a cost, that's the first one, and that comes across so very quickly in the initial meeting. If they're not engaged with what it is you're saying, it's probably an alarm bell for me.
Me too.
So that's the first point. Beyond that, an ideal client for us would be a client that's looking to scale, but scale with processes and procedures rather than in a haphazard way. And again, going back to something you said, Chris, earlier, and we're all guilty of this. When you start up, the only thing that's important is getting your first customer. You don't really think about what's the process going to look like. It doesn't matter. Get the first customer, and then you get the second one, and then the third one, and then suddenly, it's that number is a significant number, whatever that means to you and your business. And then you look around and you go, well, wait a minute, how is this going to all be recorded? How are we going to keep track of this? So somebody, a business owner that's looking for proper procedures and processes in place, whether that be financial or operational, certainly would get a big tick from me in terms of who I would want to work with.
So you may have a similar experience to me. Obviously, in insolvency, we see so many problems when a director sadly going through a process like this, and it's generally because they don't really know what questions to ask. They're not aware of what actually it's going to cost in the long run, and I'll get it. So I must get it once a week. We'll have more than once a week. We'll have somebody who'll make an inquiry, and what we've got to do is we've got to try and fact find and go, right, well, what do you owe? What are the assets? Where's the pressure coming from? What's the outcome you're looking for? How do we get from A to B legally using the tools in an insolvency practitioner's toolbox? And some people will not have that conversation because all they're asking you is, what's it going to cost me to liquidate? And these are the directors that end up with huge problems, because at insolvency, perhaps someone a bit more unscrupulous will go, it's $5,000 to get you into liquidation. And that's absolutely right. But what they've not told, I can look at a balance sheet that's online and go, well, I think you've got a director's loan account. Your accounts are 12 months out of date. Have you taken money out of the company since those accounts? Well, that director's loan account is right up here now. And that's going to blow your legs off once you appoint a liquidator. Yeah. So it's a real big red flag for me. They just want to know the cost. And in the first 10 minutes, I don't know the cost because I don't know what the problems are.
Yeah. Yeah. No, agreed, Chris.
Obviously you've been doing what you're doing for quite a while, Jeff.
Why do you say that?
I was reading up on you on LinkedIn, mate. I was reading up on you. Listen, and also the weather's bad in Scotland, so I think you're looking good for 42.
Yeah, thanks. The check's in the post.
What are the biggest mistakes that you see business owners make today?
Oh gosh,
mate, I've got another podcast at 3:00, but I'm really we'll go as long as till any of us need a toilet break, mate. So just go for it.
I think when it comes to limited companies, which is obviously kind of what we're talking about here, I think the biggest thing I see is the business owner sees the company as theirs, which of course it is. Mm-hmm. But along with that thought in the business owner's head is that means that what's in the bank account is mine. And of course it's not, because as we both know, the limited company is a separate legal entity to the shareholders and the directors. And for a director to take money out of the company for themselves, there is a tax implication at some point, somewhere down the line. And then, as we both, you mentioned director's loan account. how many balance sheets have you seen that have an overdrawn director's loan account? And I don't actually think the business owner grasps what that means. And essentially, as we both know, essentially it means that the director's taken out more money than the company has made. Yeah.
Just to add to that, I would say most directors that I speak to, and very few of them have any idea how dangerous that is, be it forcing the company going in insolvent or not and carry on trading, and they're going to get a whacking big S455 tax lumbered on the company as well. So yeah, there's so much, people just aren't educated on this point.
Yeah. And I think, the next thing that the director will say, well, there was money in the bank account. Surely there was, that money is mine. But, you take a deeper dive into that and say, well, why was there more money in the bank account? And, look at your balance sheet. The previous year, your debtors were, let's say £40,000. This year, there's £20,000. So that, some of that money's come in, which you've used for your own personal use. It doesn't mean to say that that profit was made. So that money was earned from profit in the current financial year. Equally, creditors, you may have the opposite effect here. So creditors may have gone up over the year by £20,000 or £30,000. So the implication there is that you've delayed payment to your creditors, and that's why you've got more money in the bank account, which you have then taken out for yourself. You have still got a problem. And I think the other thing too is that the directors don't appreciate that the dividend that they're taking is after tax. It's not before tax, it's after tax. And so many people do not budget for that corporation tax bill.
I think that the worst thing that I see is obviously, I was advised that best way to withdraw money from a limited company, I think you'll agree, is to take a combination of salary and dividends. But the example I use is around £1,000 a month salary. Let's say they're taking £4,000 a month, £3,000 a month in their head is a dividend, but people don't understand they're taking that £3,000 a month in anticipation of a profit where a dividend can then be declared.
Yeah.
But if since 2020, lots of businesses have found it tough, and we'll come on to it's going to get tougher, I think. So they're making less revenue. They've still got to feed the kids. They've still got to pay the mortgage, still got to pay the car. But again, it comes down to it, doesn't it? Is if you're not using an accurate profit and loss on a monthly basis, you only ever speak to your accountant twice a year. It's no surprise that these directors who don't think they're doing anything wrong. Some directors, they might be really good plumbers, really good, car mechanics, but they're not equipped to do this part of the business. And then they come to me, I'm like, oh no. And it's very hard to get back on an even keel if they get so far behind on it.
Yeah, for sure. Chris, can I ask you a question? Do you find that where a sole trader has gone from a sole trader to a limited company, do you find that's even more difficult to get the message across that the bank account is not the same as when it was? Yeah.
The biggest, obviously IR35 came in 2020, and you just have, there's thousands, tens of thousands of these one man and one woman bands who were contractors, who, IT contractors, whatever they were doing. We still get, we're still getting jobs from it now. And these people were self-employed, and they were obviously good at what they do, the generally fairly high earners. And then they're forced into, you've got to be a limited company to get this contract. And there's been some horror stories, because these people have never been set up for that. They just went to work, did what they did, and they've had years of earning really big money. So they would take the money, they'd pay the corporation tax, they pay the self-assessment, and then that model's over, so that it's all the same. These contractors, they come to us, they've took a bounce back loan, C-bills or a C-bills, and they've got huge corporation tax, they've got a big director's loan account, and they've actually got large self-assessment taxes that they've got to deal with as well. So, but you know what? It'd surprise you, because when I really think about it, it's a lot of business owners, they don't know the basics. They don't. And when you're making money, I think you can half get away with it, right? It's not ideal, but if you're making money, there's plenty of cash knocking about. You can sort of every year go, oh, crikey, it's here again, and you fumble your way through. But when we see the economy change and you know, costs going up, less people going out spending money, I think these problems are coming home to roost right now, Jeff, and I'm seeing some real tough stories at the moment.
Yeah, no, it's tough out there, absolutely, especially in certain sectors.
Yeah, flipping heck. You wouldn't want to be a restaurateur at the moment, would you?
No, absolutely not. No, I read an article during the week about, I think it was called the anticipated restaurant apocalypse. And it was in anticipation of loads of cafes, restaurants, and maybe even hotels that are going to have to, or going to be forced to close, especially after April, once the NI implications of that come through.
I mean, I am mindful of time. I only asked an hour of you, and I don't want to. I know you're a busy guy. Shall we dive into the budget, or do you want to keep talking about issues that? Mistakes that directors are making that could be avoided?
No, we'll touch on the budget. By all means, let's move on.
So, Jeff, tell us your thoughts.
Well, really genuinely concerned for, I think for smaller companies, maybe with up to 6, 7, 8 employees, it wouldn't appear, or certainly in our client base, it wouldn't appear that the changes that were announced are going to affect them too badly. So just to recap very briefly what the changes are, there's obviously the increase in the national minimum wage. There is the reduction in the employer threshold, so the point when an employer has to start contributing national insurance contributions. And there is obviously the increase in the rate as well. Okay, so it's a kind of a three-way hit. The only positive being that the employer allowance, which currently is 5,000, is going to go up to 10.5. Is it 10.5 or 10?
Oh yeah,
10.5. Yeah. So basically, that's going to double. So because of that employer allowance going up, that is helping the smaller company, 6, 7, 8 employees, or anything up to 6, 7, 8 employees, not be so badly affected. But when you get above that, certainly, and again in our client base, there can be some significant adverse situations. So what we did was we took some of our bigger payroll clients and ran, I think it was October 24. We ran October 24 payroll as if the budget applied to it in October 24. So in other words, using the rates that are going to come into play. And for some people, we're talking about £7,000 or £8,000 a month more a month that is going to cost them.
Right.
Now, there's, with the best will in the world, there's not the trade going about at the moment, unless we're very unlucky in the part of the world that we stay in, but I doubt it. I think there's not very many people who will be able to afford to take that cost on board without having to take some other course of action to reduce that burden. So I am particularly worried about hospitality and construction, which traditionally, probably you'll agree, Chris, are the two areas where most insolvencies arise. But I don't think the impact of the budget is going to do those to any favours at all.
I mean, construction has just been on a knife edge. Certainly these last couple of years, I think we sort of saw there was a lot of liquidity, wasn't there? Then when people got all the money from the government to support them through COVID, they were spending money on, home improvements. There was a lot of the property market increase, so development kept rolling. But I've seen it these last couple of years, particularly. I mean, obviously the ISG collapse, for those that don't know, ISG was a huge player, did a lot of government contracts. It was mainly a subcontractor model. They were bidding on projects for like 1% and 2% margin. It's all gone wrong. The supply chain's been decimated. But I mean, a lot of my mates are tradespeople. One of my mates is a bricklayer. He says there's no work out there on sites. He's had to get like what he calls dirty work, going out there working for a I think it's a housing authority, changing lintels and stuff. And he's had a right good time. 2020, 2021, 2022, loads of work out there. Things have dried up.
Yeah. And this is against a backdrop where there's a housing shortage. It's crazy.
And I can't see any good news at the moment. I mean, I'm dealing with the cases I've got on at the moment. These were companies that 2 to 3 years ago had quite a bit of wool on the back. They had some money, things were okay. They almost rode the wave of COVID because there was business to get there. There was business out there to get. And when you're riding those waves, you've got to take on finance a lot of times. The problem is the type of finance these business, and I'm not going to go into these lenders, but I'm sure you know who I'm talking about. Yeah. They would lend money at extortionate rates. There's personal guarantees attached to the loans. It helps them ride the wave. The wave stopped, and they've got reduced revenues. These the costs to service these debts now are absolutely crippling. And that's what I'm seeing. It's like there is no more runway to go down. And I think they think insolvencies this quarter will be the highest since 2012. And in 2012 was like the end of the fallout from the financial crash. So it's tough times out there for sure.
Yeah, and again, we'll come back to then. It's even more important why you need accurate, up-to-date financial information on a regular basis. It's just a must. It might have been optional in the good years, but it's a must.
I mean, we're going to start to wrap up, Jeff. What are your top tips for a business owner who are watching this right now? They might be having some difficulties, or they might not. They might just like funny-looking bold chaps from the north of England and they enjoy watching us. So, what are your top tips for a business owner out there?
From an accounting point of view, or just in general?
In general, please.
In general, okay. Ask questions. There is no stupid question. And especially when you're talking to your accountant, do not assume that the accountant understands your business. Do not feel daft for asking a question that you think your accountant will think you already know the answer to. Ask. And if you ask a question and you don't understand the answer, ask it again.
Yeah.
And again. And if you still don't understand what's being said, then maybe look around for a second opinion.
Anything else?
Anything else? Cash is king. Absolutely. Profit and loss account is great, but cash in the bank, you cannot beat it. And just make sure you have a good team around you. And that's easier said than done, but make sure you have a good team around you. We've not even talked about the difficulties of recruitment. Chris, but that is another major problem across the board, including accounting, dare I say. Yeah, lots of things in there. But yes, ask questions would be my top tip. Do your research.
Jeff, it's been an absolute pleasure to have you. Really enjoyed how the conversation's gone. There's going to be some real nuggets in here for people to pick out. For everyone that's watching, we're going to have all details of Jeff and his firm in the show notes underneath, and hopefully we can drop in the rolling cash flow. And if you do, or if anything that Jeff said has resonated with you today and you'd like to reach out, Jeff, where else can we find you if somebody's watching this and they want to get in touch?
Yeah, well, we've got a website, obviously, www.cikes.co.uk. I'm on LinkedIn, post fairly regularly there, so you can private message me. They're the main ways, or if you just contact yourself, Chris, even I'll be happy to respond.
Brilliant, guys. Thank you for watching. Have a wonderful day. God bless.